Picture your phone buzzing at 3 in the morning with a single alert that reads, China begins emergency liquidation of all U.S. Treasury holdings. And by the time you sit up in bed, the number on that notification has already started spreading through trading floors in Tokyo, London, Frankfurt, and New York. Because this is not a rumor anymore. This is happening in real time. And nobody in the global financial system is fully prepared for it. For years, analysts treated this scenario as an unlikely nightmare, a talking point for doomsday YouTube videos rather than something with real teeth. But in 2026, the ground beneath that assumption has shifted because China has already been quietly walking toward the exit door for more than a decade, and the pace has been picking up. As of the most recent Treasury International Capital data, China's holdings of U.S. government debt sits somewhere in the high $600 billion range, a staggering collapse from the all-time peak of over $1.3 trillion back in November of 2013. That means Beijing has already erased roughly half of its position, dollar by dollar, bond by bond, without ever triggering a headline. Grabbing single-day dump, and that is exactly the point. Because the real story is not a sudden dramatic sell-off. It is a slow, deliberate, controlled retreat that has been happening in plain sight while most people were looking the other way. China has fallen from the largest foreign holder of American debt to the third largest, trailing behind Japan, which holds more than $1.2 trillion, and the United Kingdom, which now holds close to $900 billion. China's share of total foreign-held treasuries has slipped to around 7%, the lowest level since 2001, a symbolic marker that shows this is not paranoia, this is measurable, documented ongoing policy. So the question every investor, every business owner, and every everyday saver should be asking in 2026 is not whether China will dump treasuries, because in a slow-motion sense it already has been for years. The real question is, what happens if this quiet retreat suddenly accelerates into something faster, sharper, and far more disruptive, triggered by a geopolitical flashpoint, a Taiwan crisis, a new round of tariffs, or a financial retaliation move that neither side can fully walk back? Let's actually walk through what that would mean, layer by layer, because the mechanics of this scenario reveal just how tightly connected the world's two largest economies really are, and how a weapon built to hurt one side almost always ends up wounding both. U.S. Treasury bonds are the bedrock of the entire global financial system. They are the asset that pension funds, insurance companies, central banks, and commercial banks around the world treat as essentially risk-free, the yardstick against which every other interest rate on the planet is measured, from your mortgage to a corporate bond issued in Frankfurt to a car loan approved in Ohio. When a major holder starts selling in size, prices for those bonds fall and yields, which move in the opposite direction of price, spike upward. We do not have to imagine what that pressure looks like anymore because we watched it happen in real time in the spring of 2026. When the 30-year Treasury yield climbed past 5% for the first time since before the Great Recession. And a string of Treasury auctions came in with weak demand, forcing the government to pay investors more just to get them to show up and buy. Analysts started calling this the return of the bond vigilantes, a term coined back in the 1980s to describe investors who punish reckless fiscal policy by selling government debt and driving borrowing costs higher until politicians are forced to change course. In one auction alone, the bid-to-cover ratio, which measures how much investor demand exists relative to the bonds being sold, fell to its narrowest level in more than a year, and direct bidder participation hit its weakest point since March of 2025. That is the market's way of whispering a warning before it starts shouting, and by the time China's holdings are added to that already fragile picture, even a modest acceleration in selling could turn a whisper into a scream. Now overlay that with the raw size of the debt itself, because context matters here more than almost anything else. The total U.S. National debt has crossed $39 trillion, an increase of nearly $3 trillion in a single year, and net interest payments on that debt have already blown past $1 trillion annually, consuming somewhere around 15% of all federal spending, a bigger share of the budget than the entire Defense Department in some recent comparisons. The average interest rate the government now pays across its marketable debt sits above 3.3%. Up from under 1.5% just 5 years ago, which means every single dollar of new borrowing costs more than double what it used to, and the government is borrowing more, not less. The Committee for a Responsible Federal Budget has warned that if yields simply stay near their current elevated levels, interest costs could balloon to $2.5 trillion a year by 2036, consuming nearly 30% of all federal revenue, a level that would represent one of the most dangerous fiscal spirals in modern American history, the kind economists describe with the shorthand of greater than G, where the interest rate on the debt outpaces the economy's growth rate, and the debt begins to compound on itself almost automatically, regardless of what politicians in Washington decide to do. Into that already stretched environment, drop a scenario where China begins liquidating treasuries at speed, and you get a feedback loop that spirals fast. Bond prices fall, yields spike further, the cost of servicing $39 trillion in debt jumps overnight, and Washington is forced to issue even more debt just to cover the higher interest bill. Debt that now has to be sold into a market that has already shown signs of indigestion. That is the mechanism bond traders fear the most, not a single crash, but a debt spiral that feeds itself. Meanwhile, the US dollar itself would come under enormous pressure. We already saw a preview of this dynamic in January of 2026, when the US dollar index, the benchmark that tracks the greenback against a basket of major currencies, fell to its lowest level in nearly 4 years, dropping below the 97 mark and briefly touching the mid-90s, driven by a combination of tariff threats, geopolitical tension, and a market that started questioning the credibility of America's fiscal trajectory for the first time in a generation. If China intensified its selling, other central banks holding dollar reserves would face a brutal question. Do we keep trusting an asset that a major geopolitical rival is actively dumping? Or do we start diversifying too? And once that question spreads from boardroom to boardroom, the selling becomes self-reinforcing because nobody wants to be the last one holding an asset that everyone else is quietly exiting. A weaker dollar sounds good on paper for American exporters, and it genuinely can help narrow the trade deficit over time. But in the short run, it makes every imported good more expensive for the American consumer, from electronics assembled in Asia to raw materials, to the components inside your car, to the phone in your pocket, and that imported inflation lands directly on households that are already stretched thin by years of elevated prices. Inflation in 2026 has already proven stickier than most economists expected, with headline projections revised up to around 3.6% and core inflation sitting above 3%, well north of the Federal Reserve's long-standing 2% target, largely because of an oil price shock tied to conflict in the Middle East that pushed crude above $100 a barrel at one point this year. Layer a weakening dollar and a Treasury market shock on top of that inflation picture, and the Federal Reserve, now under new chair Kevin Warsh, who took over in May of 2026, would face an impossible choice. Warsh has already signaled a hawkish shift, telling reporters that inflation remains well above target and repeatedly hammering the phrase price stability in his very first press conference. And the Fed's own June meeting saw its rate projections flip from an expected cut to a possible hike by year end, even as the benchmark rate sat steady in a range of 3.5% to 3.75%. Now, imagine that same Fed trying to simultaneously fight inflation and stabilize a Treasury market being hammered by a major foreign seller. If the Fed steps in and buys bonds to calm the panic, a maneuver that effectively means printing new money to absorb the flood of supply, it risks reigniting the very inflation it has spent years trying to tame. If it does nothing and lets yields rise on their own, borrowing costs across the entire economy spike, mortgage rates climb, corporate borrowing gets more expensive, and the risk of tipping into a recession grows by the week. There is no clean exit from that dilemma, only a series of trade-offs, each one with a real and painful cost attached. And those costs would not stay confined to Wall Street trading desks. They would move directly into your life. Mortgage rates are priced off the 10-year Treasury yield, so when that yield spikes, so does the rate on every new home loan in the country, pricing out first-time buyers and freezing an already sluggish housing market even further. Auto loans get more expensive. Credit card interest, which is already sitting at some of the highest levels in decades, climbs even higher. Small businesses trying to expand, hire, or simply refinance existing debt suddenly face a much steeper hurdle, and corporate America, much of which built its balance sheets around a decade of historically cheap borrowing, it would be forced to refinance maturing debt at rates that look nothing like what they signed up for originally. This is the part most people miss when they hear a headline like China dumps treasuries. They picture some abstract Wall Street event, but the actual transmission mechanism runs straight into paychecks, mortgage applications, and credit card statements. Now, zoom out to the rest of the world, because U.S. Treasuries are not just an American story. They are the backbone collateral of the entire global financial system, used by banks everywhere as the safest asset to post against loans, used by central banks as the core of their foreign currency reserves, used by insurance companies and pension funds as the bedrock of long-term, low-risk portfolios. When that bedrock starts cracking, the tremors do not stay inside U.S. borders. European and Asian equity markets would likely fall in sympathy. Emerging market currencies, many of which are already fragile and dependent on dollar funding, would come under intense pressure, and the entire architecture of global trade finance, which quietly runs on dollar liquidity and treasury collateral behind the scenes, would seize up in ways that are difficult to predict in advance and even harder to unwind quickly. This is precisely the environment where investors around the world start scrambling for safety, and in 2026, we have watched that hunt for safety play out in real time. though not in the way many crypto enthusiasts expected. Gold has been on an absolutely historic run. The metal smashed through $5,000 an ounce for the first time ever in January of 2026, eventually setting an all-time high above $5,500 before correcting back down into the $4,400 to $4,700 range by spring as some of the immediate panic eased and rate expectations shifted. Even after that pullback, gold was still up more than 60% on the year at one point, one of the greatest 12-month runs for the metal in modern history. And central banks were not sitting on the sidelines watching. They were the ones driving a huge share of the demand. In the first quarter of 2026 alone, central banks bought 244 tons of gold on a net basis, extending what analysts are now calling the strongest sovereign gold buying cycle since 1967. And China's own central bank, the People's Bank of China, has now extended its own gold buying streak to 17 consecutive months, pushing its officially reported reserves above 2,300 tons, with gold now making up close to 9% of China's total foreign exchange reserves, up from a tiny fraction just a decade ago. Poland's central bank became the single largest sovereign gold buyer for 2 years running. Kazakhstan set new records of its own. Brazil re-entered the gold market after a 4-year absence, and surveys from the World Gold Council show that more than 40% of central banks worldwide plan to keep adding to their gold holdings through the rest of 2026, with the overwhelming majority expecting global reserves to keep climbing over the next 5 years. That is not a fringe trend anymore. That is a structural, coordinated repositioning of how the world's most conservative financial institutions think about safety. And it tells you everything about how seriously governments are taking the possibility of exactly the kind of Treasury shock we are describing. But here's where the popular narrative from a few years ago actually broke down in practice, because Bitcoin, the asset so many people expected to behave as digital gold during exactly this kind of crisis, did not behave that way at all in 2026. When gold surged past $5,000 in January, Bitcoin was sliding, falling from its October 2025 all-time high above $126,000 down into the $67,000 to $88,000 range over the following months, a drop of roughly 40% at its worst point, moving in lockstep with tech stocks and the Nasdaq, rather than acting as an independent safe haven. When conflict escalated in the Middle East in February of 2026, gold jumped more than 5% in the first 48 hours, while Bitcoin fell 12% in that same window. And the one-year rolling correlation between the two assets actually turned negative, meaning they were moving in genuinely opposite directions, rather than functioning as interchangeable stores of value. Analysts who track this closely now describe Bitcoin's digital gold thesis as something that might hold up over a multi-year horizon but consistently fails the test during an actual short-term crisis, because Bitcoin remains extremely sensitive to leverage, liquidity conditions, and risk appetite, the same forces that hammer tech stocks during a panic, while gold benefits from centuries of institutional trust and a buyer base, namely central banks, that does not sell in a panic the way leveraged crypto traders do. That distinction matters enormously for this scenario, because it tells you that if China ever did accelerate a Treasury sell-off, the safe haven flows would almost certainly concentrate heavily into physical gold, into the Swiss franc, into the Japanese yen, and into short-term cash instruments, rather than spreading evenly across every asset marketed as a hedge against chaos. Now let's talk about the side of this story that gets far less attention in the breathless headlines, which is what a Treasury dump would actually cost China itself. Because Beijing is not some outside observer who could pull this lever for free, it would be lighting its own portfolio on fire in the process. Selling hundreds of billions of dollars in bonds quickly means accepting sharply lower prices for that debt, since dumping that much supply into the market without crashing prices further is essentially impossible. So China would be locking in enormous realized losses on an asset it has already been discounting for years. At the same time, a U.S. economy shaken by a bond market crisis buys fewer Chinese goods, and China's export engine is not in a position to absorb that kind of shock painlessly right now. China's economy grew at just 4.3% in the second quarter of 2026, the slowest pace since the depths of the pandemic lockdowns in late 2022, even as exports were actually surging, up more than 17% in the first half of the year, boosted heavily by global demand for artificial intelligence, hardware, and Chinese electric vehicles. The reason growth still slowed despite that export strength tells you everything about how fragile the rest of China's economy really is beneath the surface, because domestic investment in fixed assets like factory equipment fell nearly 6% in the same period. Retail sales barely grew at all, and the country's property sector, which has been in a prolonged grinding slump for years, continued to weigh on household wealth and confidence. China's own manufacturing data has shown factory growth cooling faster than economists expected, and Beijing has set an official growth target of only 4.5% to 5% for the year, a notable step down from the breakneck pace the country used to post regularly. In other words, China cannot afford to torch its largest export market on a whim, because if a Treasury shock triggers a genuine American slowdown, the demand for Chinese goods would soften, right as Beijing is already fighting weak domestic consumption, a still struggling housing sector, and a growth target it is straining to hit. This is the mutual destruction dynamic that makes an all-at-once, headline-grabbing dump so unlikely even as the slow, steady retreat continues in the background, because Beijing has every incentive to keep bleeding its position down gradually while diversifying into gold and other assets, and almost no incentive to detonate the position in one dramatic move that would blow up its own balance sheet and its own export economy at the same time. This is also exactly why the real trend to watch is not a single dramatic dump, but the broader, accelerating story of de-dollarization, which has moved from a fringe talking point into mainstream policy planning across dozens of countries in 2026. The dollar's share of global foreign exchange reserves has fallen from roughly 73% back in 2001 to somewhere around 54% today, according to International Monetary Fund data, a structural decline that has been building for 2 decades and is now accelerating. Russia, India, and China now settle roughly 90% of their mutual trade without ever touching a US dollar, using direct currency swaps and alternative payment rails instead. The BRICS bloc, now expanded well beyond its original 5 members to include countries like Iran, Egypt, Ethiopia, the United Arab Emirates, and Indonesia, together represent close to 40% of global economic output when measured by purchasing power, and the bloc has been actively building out infrastructure like BRICS Pay, which links national payment systems such as Russia's SPFS, China's CIPS, and India's UPI, alongside cross-border digital settlement systems like mBridge that already allow instant payments between central banks in China, Hong Kong, Thailand, and the United Arab Emirates using digital currencies, cutting dollar intermediaries out of the process almost entirely. None of this means the dollar is about to collapse or lose its reserve currency status overnight, and it's worth being honest about that. Because the euro, the only currency with anything close to the institutional depth to seriously challenge the dollar, still represents a fraction of global reserves, and no BRICS common currency has actually launched despite years of speculation, with India's own foreign minister publicly stating the country has no policy to replace the dollar and calling it a source of global economic stability. What is happening instead is more accurately described as a gradual structural diversification, a slow rebalancing away from total dollar dependence rather than a dramatic dethroning. But slow and structural does not mean harmless, because even a modest, sustained shift in reserve composition changes the marginal buyer for U.S. debt. And when the marginal buyer becomes less reliable, the U.S. government has to offer higher yields to attract the exact same pool of capital it used to get almost automatically. So let's bring this back to the original scenario and ask, honestly, what would actually happen if China did suddenly announce it was liquidating its entire Treasury position overnight. In the first hours, you would see exactly the chaos described at the very start of this video. A Treasury market sell-off, a yield spike, a stock market sell-off, a scramble for safe havens concentrated heavily in gold rather than crypto, and a Federal Reserve caught between fighting inflation and stabilizing markets. Within days, though, the story would likely start to shift, because the U.S. Treasury market remains, even after everything we have described, the deepest, most liquid bond market on the planet, with a daily trading volume that dwarfs almost every other market in existence, and that depth matters enormously in a crisis. Domestic buyers, including American banks, pension funds, and mutual funds that are contractually required to hold high-quality government debt, would step in to absorb much of the supply, especially once yields rose to levels that started to look genuinely attractive, and other foreign buyers, including sovereign wealth funds looking for a bargain after a panic-driven price drop, would likely follow. The Federal Reserve, even under a hawkish new chair focused on price stability, retains tools to prevent an outright market breakdown if functioning genuinely seized up, because a disorderly collapse in the world's most important collateral market is the kind of systemic risk that no central bank can simply watch unfold without acting, whatever its stated policy priorities happen to be at that particular moment. Over the following months, you would likely see the immediate panic fade, even as the deeper structural damage lingered. Higher average borrowing costs for the U.S., government baked in for years, a permanently more cautious relationship between Washington and Beijing, an accelerated timeline for the de-dollarization trends already well underway, and a global financial system that emerges more fragmented, with more countries hedging their bets across multiple currencies and assets rather than parking everything in dollars and treasuries by default. That is really the core lesson sitting underneath this entire scenario, and it is worth sitting with for a moment before you close this video, Because in a genuinely interconnected global economy, the biggest financial weapons are almost always double-edged, built with a blade on both sides of the handle. China holding hundreds of billions of dollars in US. Debt was never really a gift to Washington. It was leverage. But it was also China's own money locked into an asset it cannot destroy without destroying real value for itself in the same motion. The United States running record deficits and record debt levels was never a free lunch either, because every dollar of that debt eventually has to find a buyer, and the more the world hedges away from automatic dollar dominance, the more expensive that borrowing becomes for every future generation of American taxpayers. Gold's historic run in 2026 tells you that the smartest, most risk-averse institutions on Earth, the world's central banks, are already positioning for a more fractured, less dollar-centric financial order, quietly, patiently, and without a single dramatic headline moment to mark the shift. And that quiet, patient positioning may end up being far more consequential than any single overnight crisis ever could be, because it is happening right now in the data, whether or not the headlines are loud enough for most people to notice. There's one more angle to this story that almost never makes it into the viral version of this scenario, and it deserves real attention before we wrap up, because it changes how you should actually think about risk here. Japan, not China, is the largest single foreign holder of U.S. Treasuries, sitting on more than $1.2 trillion in American debt, and Japan's own domestic bond market has been going through its own quiet turbulence in 2026, with yields on Japanese government debt climbing to levels not seen in decades as the Bank of Japan slowly unwinds years of ultra-loose monetary policy. If Japanese life insurers and pension funds start finding better returns at home, they have far less incentive to keep recycling their trade surpluses into U.S. debt the way they have for generations. And that is a second, quieter pressure point on Treasury demand that has nothing to do with Beijing at all, yet could compound any China-driven shock and make it considerably worse. The United Kingdom's holdings have also crept up toward $900 billion in recent years, partly reflecting the fact that a huge amount of global dollar-denominated trading and custody runs through London, which means UK Treasury figures are not always a clean read on genuine British appetite for American debt. They are partly a reflection of financial plumbing rather than conviction. Belgium, home to the Euroclear settlement system, shows up on these tables for similar plumbing reasons, holding hundreds of billions that likely represent other countries' assets parked there for custodial purposes rather than a genuine Belgian bet on US. Understanding this matters because it tells you the foreign ownership picture is messier and more layered than a simple ranking of countries suggests. And it means the real vulnerability is not really about any single nation's decision. It is about the aggregate confidence of the entire foreign buyer base at once, official and private, direct and indirect, all of it resting on the same underlying assumption that America's fiscal path is sustainable over the long run. Credit rating agencies have already started chipping away at that assumption, with Moody's stripping the United States of its last remaining top-tier AAA credit rating in 2025, following similar downgrades from Standard & Poor's back in 2011 and Fitch in 2023, meaning all three major agencies now rate U.S. debt one notch below the pristine status it held for most of the post-war era. Each of those downgrades came with the same underlying warning attached: rising debt, rising deficits, and a political system that keeps kicking hard fiscal choices further down the road, rather than confronting them directly. And each downgrade barely moved markets in the moment, mostly because treasuries remain the default safe asset with no obvious substitute of comparable size and liquidity. But the cumulative effect over time is a slow erosion of the unquestioned trust that used to define how the rest of the world viewed American debt. That erosion is precisely the soil in which a China-driven shock, or a Japan-driven shock, or simply a series of weak auctions strung together, could take root and grow into something much larger than any single event on its own. Now think about how this plays out for an ordinary household watching all of this unfold from the outside, because that is really who this story is for. If you are a homeowner with an adjustable rate mortgage, or you are shopping for your first home in this environment, a treasury shock translates almost immediately into a higher rate quote from your lender, potentially adding hundreds of dollars to a monthly payment on a very ordinary sized loan, pricing entire households out of homes they could have afforded just months earlier. If you are running a small business and relying on a line of credit to manage seasonal cash flow, a spike in benchmark rates flows straight through to your borrowing costs, squeezing margins that are often already thin. If you're close to retirement and holding a portfolio that leans heavily on bonds for stability, a sudden treasury sell-off does not feel abstract at all. It shows up as a real, visible drop in your account balance on exactly the assets you were told were the safe part of your portfolio. And if you hold any of your savings in gold, either directly or through an exchange-traded fund, the 2026 data suggests you would likely be one of the few groups actually benefiting from the chaos, at least on paper, which is precisely why central banks around the world have been accumulating the metal so aggressively, even while publicly insisting they see no imminent crisis on the horizon, because institutions that manage risk for a living tend to prepare quietly for scenarios they would never announce publicly in advance. So, where does that leave us? The single overnight, headline-grabbing dump of the kind described at the start of this video remains unlikely, not because China lacks the holdings to make it hurt, but because China would be shooting itself in the chest to shoot the United States in the leg, and Beijing's own policymakers understand that math as well as anyone on Wall Street does. What is far more likely, and what the actual 2026 data already shows happening in real time, is the slower version of this story, a steady reduction in Chinese Treasury holdings that has already cut China's position roughly in half from its peak, a parallel and historic surge in central bank gold buying across dozens of countries, a broader global de-dollarization movement that is chipping away at the dollar's share of reserves year after year, and a U.S. fiscal position that keeps generating record deficits and record interest costs regardless of which party controls Washington. None of that requires a single dramatic news alert to matter. It only requires patience and attention, because the slow version of a crisis is the one that actually reshapes the world, while the dramatic version mostly just makes for a better headline. The lesson from all of it is remarkably consistent, whether you're looking at the fast scenario or the slow one already unfolding. In a global economy this deeply interconnected, there are no financial weapons that only damage the other side, every major economic power holding U.S. Debt is also, whether it wants to admit it or not, betting on the long-term stability of the American financial system. And every dollar the United States borrows is also, whether Washington wants to admit it or not, a bet on the continued willingness of the rest of the world to keep lending. That mutual dependence is not a weakness to be exploited cleanly by either side. It is the entire architecture holding the current global financial order together, fragile in places, resilient in others, and shifting more quickly beneath the surface in 2026 than most people watching from the outside have fully grasped yet.